Welcome to Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
Welcome back to the Roadmap to Retirement podcast. I'm delighted to be joined by John Howe. John, introduce yourself to our audience. Who are you? What do you do? And why are you here?
Yeah, so I'm John Howe, aka John Howe-Wemett. I am a certified financial planner professional at Generation Capital Management, and I'm here because Alex asked me to be here.
That's a great reason. I think it's cool to have advisors on from different firms. I think it's a cool opportunity to collaborate with other people.
Yeah.
I think there are people out there that would say, why are you promoting another advisor, another firm? But I think anytime I can promote one of the good guys, I'm happy to do that.
Yeah.
We'll stay away from that topic, but not everybody's a good guy. So happy to be doing this. Today's topic, we thought we'd discuss a little bit about what do financial advisors actually do.
Mm-hmm.
I think we were talking before we started recording about the misconception that a financial advisor and a wealth manager or asset manager are equivalent, and that's just not true. I think a lot of people just jump to how's my portfolio performing, what's the rate of return, what stocks, bonds, whatever, what should I be invested in, but there's a lot more to it.
Right.
So to kick us off, what are your general thoughts about that topic or what's important to people?
Yeah, so I think that there's a lot there. There's a ton of information flying around about investments. Everyone seems to be really interested in investments. I don't know if you've had this same experience, but when I go to a party and people find out what I'm doing, what I do for a living, one of their first questions is, do you have any stock tips? Do you have anything that I should be investing in? And my first answer is no.
Oh, crypto?
Oh, yeah, should I be in crypto? It's hard to break through that sometimes because investing, I think that there are a couple of things that go on with investing. People think that they should know more than they do. Mm-hmm. People want to tell you that they know more than they maybe do. And they think that investing is important, but they don't necessarily know how important it is in relation to all of the rest of their finances. So what I've found is that people place an undue emphasis on the investments. So when you're as a financial planner, as someone who doesn't usually focus on investments during my client meetings, it's hard for me to break through that ideology that they have, that presupposition that they have, and help them to understand that there's significantly more value to the financial planning process than there is to focusing singularly on investments.
Mm-hmm. I think I've almost taken this too far in the way that I think about it, not necessarily the way I communicate it. Like, the investment piece has become such a commodity in today's market.
Yeah. In
my opinion, I think that you can say you're a moderate investor, you can go directly to a Vanguard or Fidelity and you can get a moderate fund, and it's probably going to perform pretty similarly to anything any advisor is going to introduce you to.
Right.
And I think because of that, you really, as an advisor, have to focus on all the other things that go into a successful financial plan. I think that if you focus too much on the investment, and an easy example is like if you compare two funds or two portfolios and they're within 1% of each other, can I find a way to improve my financial situation by more than that 1% or a specific dollar amount that's associated with it by doing the proper tax planning, estate planning, insurance planning, everything else that goes into it?
Right.
And Again, I don't want to say it too strongly, but you can almost make the investment piece not matter. And of course it does matter, right? There's still bad portfolios. We want to stay out of that. Mm-hmm. There's better and there's good. But I think on the tax planning especially, there's a huge opportunity to pay less in taxes, and that will more than make up for that 1% between portfolio A and portfolio B at the same risk level.
I agree. And I think that one of the things that people need to remember too is that it's really hard to beat the market, if not impossible on a consistent basis. I think that in the financial services industry, one of my favorite things to say is that if there's billions of dollars in the financial services industry, maybe even trillions of dollars. And if there was the possibility that someone could consistently outperform the market, someone would be doing it.
Yeah. And it goes back to what you were saying before about you talk to clients or the people at the party, they're talking about the rate of return, and they all seem to have convinced themselves that they know something that you and I know they can't possibly actually know. And it's like that hindsight bias. I knew that when this happened, the market would go up or down. And it ties directly into the election cycle that we're coming up on. I know if so-and-so wins, this is going to happen in the market. And first of all, you don't know that. So just stop. And secondly, like all the people, to your point before, that do this for a living, the trillions of dollars are in the system, like the best asset managers in the world, the people that went to school forever to do this, the people that are way smarter than anyone in this room besides you, like they still can't consistently beat the market. Right. So buddy at the cocktail party that's convinced he knows something is probably wrong, and somebody should find a nice way to tell him that.
Yeah, and I think that part of the drawback of that in specific is that you can chase returns at the detriment of other things. Mm-hmm. So you become a slave to the idea of outperforming, so that the only thing that you're focusing on, if you're focusing on your finances, the only thing that you're focusing on is your investments. And it does become something that I think it can hold people back significantly, especially something like trying to time the market. Mm-hmm. I would say 9 times out of 10, when I've seen people try to time the market, they get it wrong.
Yeah, and I've seen people, if you look back at the last 10 or so years of history, people that got out of the market completely because they didn't like who the president was, mm-hmm. people that got out of the market because, well, COVID happened or something like that, and they thought that this was the end, this time is different, is what we hear. Mm-hmm. And if you do the math on it, somebody that's been sitting in cash for 5 or 6 years at this point has lost a tremendous amount of value because Absolutely. They thought they knew something that they didn't know. Yep. Whereas if they had just accepted that the market will go up and down, there will be good years and bad years. Mm-hmm. When it goes down, it's probably not the end of the world. When it goes up, it's probably not because of one person's credit. I think you got to be careful on how you say it, but it's something people should be cautious of.
Yeah, absolutely. And that's part of what we do, I think, on the investment front. So regardless of whether we manage the investments ourselves or someone mm-hmm. else manages the investments, part of our job as financial planners is to help people manage their expectations and manage their emotions.
Yeah.
So that when those crisis moments come, we help them to have that clarity. And I think that's one of the most important things that we do in terms of investments. It's not necessarily selecting the portfolios as much as it is just making sure that people don't make the wrong decision.
Yeah, and the wrong decision is so expensive. So it's making sure that we can talk you off the ledge when you're feeling emotional. And I think one of the reasons I'm going to get this wrong, but there's a JP Morgan study out there that shows the average rate of return for the average investor versus what the market's done. Mm-hmm. And I think it had, over whatever the time frame they gave, that there's about 3% was what the average investor was getting.
Okay.
And then the market return was closer to 9 or 10%. Sure. And the difference was that the average investor gets emotional. They see the market go up. They feel great about it. The market's going up. Let me put more in. Mm-hmm. They see, oh no, the market's down. This is a bad time to invest. Let me pull out. And they start to try to time the market like you're talking about, and they actually get a worse rate of return. So one of the things that we as advisors can do is become just that gatekeeper between your emotions trying to make a decision and what the reality is. So in the worst case, if you say, I want to make this knee-jerk reaction, you have to call me and ask first and explain your logic to me on why you think this is a good idea. And at the end of the day, it's your money, so I can't stop you from doing what you want to do. Mm-hmm. But a lot of times just having that conversation talks you off the ledge. And now we're hopefully going to have more clarity and make a good decision and not be that average investor that's getting a third of the rate of return that they should be getting.
Yeah, and I think part of that, making sure that clients understand that's part of your role, is having those constant conversations about their risk and potential return. So if we're having consistent conversations about if the market is down 20%, you can expect to be down 10% mm-hmm. based on the analytics of the portfolio, then when they wake up on some terrible day and the S&P 500 is down 20% and they see that their portfolio is down 10%, it's still jarring, but it's less jarring because they've already had their expectations set that could happen.
Yeah, there's so many tools available to us now as advisors where we can, it's not perfect, we can simulate different scenarios. What mm-hmm. if this happens in the economy, or what if this World War III happens? How does it affect a potential portfolio? And you gotta be careful not to tie too much of your expectations to exactly what that tool is showing us, but it does give us a gauge of, okay, if this happens, your portfolio is down 15%, how do you feel about that as an investor? Yeah. And then based on that, we can decide, is this an appropriate amount of risk or not? And I think by on the same kind of idea, when you have people talking to each other at like a cookout, like you were saying before, and I got 7%, I got 10%, you got to keep in mind that people have different investment goals.
Yep.
Is your goal as an investor to get the absolute best rate of return possible? Or is it to make sure you're managing your money in a way that you can reach all of your goals throughout the rest of your life or through your retirement?
And sleep at night.
Yeah. If you've done a great job saving for retirement, you don't need to take on all the risk that your neighbor's taking on. Yep. maybe it's okay to get a lesser rate of return to know that you still have enough money to fund everything you want to do for the rest of your life.
Yeah.
And leave something behind to the next generation if that's part of your goal.
Yeah. Couldn't agree more.
Great. Just two guys sitting around agreeing with each other.
We solved it. We solved the investment problem.
Yes. All right. So we covered investments. We talked about why it is important, but it's not all of your financial plan. What do you think the biggest missing piece for most people is in their financial plan? What's the thing that they're overlooking because they're so focused on what we've already talked about?
Spending.
The
number one thing that I think that people miss is spending.
You think people need to spend more?
Of course.
Okay.
No, I think that people don't focus on their spending either in the way that they need to spend less or they need to spend more.
Okay.
So when I put together a financial plan for a client, the very first thing that I look at is what did they spend over the past 12 months? That is step one. Whether the client has $10 with me or $10 million with me, it does not matter. That's what I look at first. And what that does is it helps put into perspective for the client what their current lifestyle is. And when I say that I'm looking at spending, I'm not asking them what they spent. I'm saying either pull all of your expenses or give me access through our financial planning tool for me to actually take a look at the transaction so that I can add them together. Because I don't know if this has been your experience or not, but in 100%, I should say in like 99% of the scenarios, and the people that are watching this who are like the 1 or 2%, they know who they are. 'Cause I make it very clear. But 98% of the clients that I work with, and I ask them to send me their spending. They'll send me a rough budget, and I can always tell when it's wrong because it's round numbers. I spend $1,000 per month on miscellaneous, or we spend $200 per month on gas. That's usually the first indicator to me that people aren't actually going through the process of looking at their expenses and seeing what they actually spent. So yeah, I go right through that. And when someone sends me their initial budget, which is what they call it, not their spending, they send me their budget, and then I actually look at the actual spending. There's usually miles between the two numbers. And I think that people, and almost every time that happens, people are genuinely surprised by the actual amount that they are spending.
Yeah.
It really takes them back. And then when I'm working with retirees or people who are towards the end of their lives, and they're starting to see that they're going to have all of these assets, and having a large estate wasn't part of their plan. It wasn't part of their goal. They start to realize that they maybe weren't spending enough, even though we might have been telling them for years that they could spend more. So spending is, people always think too that when they talk to me, I'm going to tell them what they can and can't spend on. And then I tell them, I don't care what you spend on, because you're prioritizing what's important to you. I want you to spend on the things that are important to you, but you need to know how much you're spending versus how much you're bringing in. If you're spending too much, you need to figure out how much you can pull back in all these different areas. I'm not going to tell you that you can't have your Xbox subscription. I'm not going to tell you.
You don't tell them. I tell them they can't.
Maybe that's a different.
They don't talk to me. I don't know. It's weird.
Yeah, I guess so. But I think that spending is probably the number one area that people don't even think about. Everyone thinks that they know what they're spending. But
it is fascinating. Like, people are so disconnected from that. And I do have some people that I work with that they're usually the engineer type, and they're very detailed, and they will show you a spreadsheet that shows every penny they're spending, and it's pretty accurate. But like, I've worked with young professionals or professionals in general who they have a good income. Maybe they're making $200,000 a year, which especially in the Rochester, New York market, like they're pretty good, right? Yeah. And they make $200,000 a year. They tell us that their budget is they need $50,000 a year to live on, and then it's where's the rest of it? Because you've got $20,000 in the bank, and you have an extra $150,000 of income. Apparently, yes, taxes are part of that, but there's just such a disconnect there. It's fascinating to see, to start to uncover that conversation, and then open their eyes to the fact that they are spending on a lot of different things. And I think people fall in the trap of thinking that whatever they're purchasing this year is a one-time expense. It's normally I don't spend this much, but we got the kitchen remodeled this year. Or normally I don't spend this much, but we went on this trip, or our daughter started college. And there's these things that feel like a one-off thing, but the reality is if you have a one-off thing every year, it's not really a one-off thing.
Exactly.
And to your point, I made a joke before, but no, I'm not going to tell you what to spend money on. I'm not going to follow you around and look over your shoulder as you buy that Coke at lunch. But just being mindful of it and having a true understanding, I think, is important. And
Yeah.
then the other thing you mentioned, which we run into this all the time, is people at the other end of it. They're retired, they've saved all their lives, and they're usually people that have always been very financially conservative,
Mhm.
great savers, put money in their 401k, IRAs all these years, and now they're in their 60s or 70s, and they've got X amount of dollars on the sideline invested, and you can't get them to spend it.
Mhm.
And ultimately, it's up to them. But there's like this psychological thing of being in saving mode for 50 years while you're working,
Yeah.
and then you have this nest egg built up, and it's your choices are either starting to spend it or having a different conversation about leaving it to the next generation. But I think people have a very hard time spending that money they saved. They will
Mhm.
drive their broken down car, and they will eat their peanut butter and jelly sandwich every day
Yeah.
and not touch that money. How do you
Yeah.
find do you have any strategies for trying to help people overcome that, or what have you found to be successful?
It's harder. So, generally speaking, I found some success in understanding. I took a class during my master's program called financial therapy.
Okay.
And we studied money scripts. And money scripts are basically the beliefs that we hold about money, and they are a product of our money history. And they are perpetuated by the habits that we have, the money habits that we have, the choice, every next choice that we make about money influences our money script and then influences that next choice that we make. So it just keeps perpetuating.
Mhm.
I've had some success talking to clients and helping them to understand their relationship with money in that way. I think that's maybe one of the interesting things that I do as a planner is just I'm really interested in the emotional side of money, like your relationship with money. And so I just try to help them to understand why they might be frugal, why they might be unnecessarily frugal, what in their lives might have led them to make those choices. And the hard part is so I would say that generally speaking, this is broad strokes, but younger clients are more open to those conversations.
Mhm.
Older clients have a little bit of a harder time with it. And I think that it has to do with the fact that they've spent so long with those money scripts. And also especially for frugal clients, you have the fact that them being frugal got them to the point of success where they're at now.
Mhm.
So then convincing them, not necessarily that it's a bad thing, but that it's a choice they need to choose away from is a really hard,
Sure.
it's a really hard thing
Oh,
to
it's
do.
just like anything else. You can't teach an old dog new tricks, I guess is the
Right.
saying.
Yeah.
They don't want to be called dogs, but
No one does.
no one does. Yeah, it's hard to change those habits after so long.
Yeah.
And sometimes you sit with retirees and you're like, okay, now you have the time to do a lot of different things you didn't before.
Yeah.
Some of those things cost money. Is there anything you've always wanted to do?
Yeah.
That if you remove money from the decision, if it's just what do you want to do today and don't think about the cost, is there something you would do?
Yes.
And then you get back into, okay, maybe it's okay to take X amount of dollars from your retirement account and use that for your trip you've always wanted to go on. Maybe you wanted a boat. Maybe you want to buy an RV and travel the country.
Right.
Like it's okay to go do those things, like almost giving them permission. And I find that sometimes when the financial planner tells them it's okay to spend money, it removes some of the anxiety that they normally have around spending money.
I would agree with that. And one of the nice things about financial planning as a profession is that we rely on the plan to tell us what can and can't be done. And we all have different assumptions that we use. And I'm sure that my plan looks different from your plan. But at the end of the day, we generally have Monte Carlo simulations that tell us the probability of success. And when you tell someone you have a 97% chance of success and your most likely ending balance in your plan is over $3-4 million, which means that most likely, according to the plan, at the top of the bell curve, you're most likely to die with $3-4 million. That really puts it into perspective for them, because it's really hard to imagine all of the moving pieces in our financial lives and how they would then eventually, how everything will look at the end of our lives. But when you put it on paper and show them, if all of these things are true that we just spent the past hour, 45 minutes talking about, then this is what could happen. How would we change that? How would you want to change that? What are some things that you, at the end of your life, would regret not having done? And just trying to make it more salient for them, I think, is really one of the gifts that we get to have as financial planners, not financial advisors or brokers.
Right. Yeah, there's a distinction there. And I think, yeah, when you give them a real number at the end of the day and you say there's an extra $4 million that's going to be there in It might be 20 years from now.
Yeah.
What do you want to do with that? It does start to change the conversation a little bit.
Mm-hmm.
We find a lot of people, especially if they're maybe don't have kids and they don't have an obvious beneficiary or an obvious heir to leave the money to,
Yeah.
it becomes a little bit of, I don't call it a crisis, but later in life, it's a searching for meaning of like, where does this money go if I'm not here? Is there charity I want to support? Is there something else? Whereas if you've got adult children that you feel could use the financial support at some point, maybe it's an easier transition away.
That's a great point too. One of the other things that you asked me, so previously before I talked about spending, you asked me what do I think is the biggest area of opportunity, or the thing that we're not looking at the most. So spending is the thing that clients don't look at the most, but I think that the biggest opportunity area is tax planning, because if you can, it's one thing to earn another 1 or 2% for a younger client who maybe only has $20,000 or $30,000 invested. That can be a small amount, but if you can find them a couple $1,000s in their tax return that they missed out on, or their tax preparer missed out on, or recommend a tax strategy that'll just save them that much money, that can really move the needle for someone who needs that money.
Yeah, you are preaching to the choir in tax money. I feel like that is where all my conversations go. We do seminars on it. I think tax planning, I could not agree more, is like the biggest missed opportunity. And if even just like for people that don't know this, go Google the federal tax brackets. Look at the jumps in there. Like going from 12 to 22% is a big deal. If you're somebody that's on the cusp of that, you can do a lot of maneuvering a year to try to stay in the 12% bracket. And again, if we're saving 10% on the last dollar of taxes, that can easily outweigh the difference of what we were talking about before, obsessing over the extra 1% rate of return. Let's save 10% on taxes. Does that work for you? It probably does. But there's a lot of tax planning strategies I think retirees aren't even aware of. And when you get into the actual retirement phase, so like 55 to 70, like those years, you start to look at the RMD stuff. Not yet. RMDs are later than that, but RMDs are coming. And if you plan correctly for those, you make a big difference. You look at your Medicare premiums, you look at the opportunities for claiming Social Security at different ages, you look at Roth conversion opportunities. There are a ton of decisions you need to make, 55 plus, we'll call it, that will outweigh anything else you're going to do financial planning wise.
Yeah. And it kills me because I think that people don't even know that we do that. They're like, oh, what is financial planning? And how are you different from an accountant? Don't prepare tax forms, right? We're not going to, I don't.
Okay.
We don't. The collective we here are not going to prepare your taxes. But what we can do is we are the people who have the 30,000 foot view and lower. We have the details about your financial situation, and we can help you to figure out what you need to coordinate a more successful financial situation for yourself. We have enough knowledge about the tax code to be able to help guide, while also using the advice of a tax preparer to give us specific dollar amounts for those types of things. I think that people are unclear about what we do in terms of tax planning, which is a big challenge.
It's also a hard thing. All of financial planning is a hard thing to, there's no tangible good, right? So a lot of times when we're having that introductory conversation and you talk about what we do, the relationship we want to have with you, the fees that are associated with that, you find some people want to say, I'd rather just have somebody I can reach out to when I have a question rather than having an ongoing relationship. And the problem with that is a lot of times you don't know the question you should have. There are things that the right advisor should be pointing out to you that having that continuous review meeting as an ongoing relationship allows you to do. Nobody's picking up the phone and calling and saying, hey, I just wanted to talk about how the Social Security tax torpedo is going to affect my retirement, because they don't know to ask that. But having that ongoing meeting allows you to do that, and especially true for tax planning. I think it's important to have the continual cycle of let's talk about your tax return in the spring. Let's talk about some end of the year tax things, tax loss harvesting, Roth conversions, all those things that have to be done before December 31st. And if you're not continually doing that, there's, I don't want to say it's impossible, there's almost no way that you're catching all the things you need to catch by yourself.
Yes, I agree. And one of the things that I say, and I love all the CPAs that I work with,
they're nice people.
They're awesome.
They're fun too.
They're super fun. But one of the things that I will say is that sometimes it feels like their tax year their 2023 tax year went from January 1st of 2024 to the tax filing deadline of 2024. For us, the tax year starts January 1st of 2023 and it ended April of 2024. So we are involved
ongoing.
the entire time. Yeah, it's an ongoing process. It's because we're constantly analyzing your situation and figuring out how we can guide you.
I think it's also just, it's proactive versus reactive.
Yes.
I don't want to say, again, I know some great CPAs that are a little bit more proactive, but generally speaking, your CPA is looking at the numbers that you did the previous year.
Yes.
Based on that, this is what you owe in taxes, or this is what you're getting back. Whereas the financial advisor should be proactive in actually moving the needle and making recommendations. Like, very few CPAs are going to say, hey, you should contribute to an IRA, or hey, you should do this differently. When they file your taxes, they just say, here's your bill and this is what it is.
And that's I think part of what we do too. So when we partner with CPAs, it's an ongoing conversation all year long.
Mm-hmm.
So if we do have a question about a particular situation, we can reach out to, so if we have the relationship with the CPA, we can reach out to them and say, hey, what if we did this differently? And they'd be like, oh, that's a pretty good idea. Yeah, you could definitely do
Pretty
that.
good idea.
Yeah. Okay.
Good job, John.
All of my phone calls, I'm doing, John, that was a really great idea.
So that must be nice.
Of course. So yeah, I think there's a lot of value to be had, and the dollar amounts can just be so big when it comes to tax planning.
Yeah, it's huge swings. It's, again, some examples. I don't know if we have time for that, but all right, talk about tax planning.
It's your podcast.
It is my podcast. All right, let's do a few more minutes and we'll wrap it up. So we talked about spending, or getting a grasp on that. I like how you say spending, not budget, because budget is
a dirty word.
It should be the same thing, but maybe it's not the same thing. It should be the same thing. Okay,
but it's not.
Talk about taxes. What is another? Let's throw a third thing in there that you think people are maybe overlooking when it comes to financial planning.
Yeah, so I guess I would probably say estate planning.
Okay.
I'd be inclined to say retirement planning, but that's almost what everyone is on board with.
How do you feel about insurance? Is that a dirty word?
Oh my goodness. You and I have had this conversation before. So insurance, I'd love to. Let's talk about insurance.
You want to talk about insurance?
Yeah, let's talk about insurance.
It's a dirty thing, so that sucks. But
well, stay tuned in, because your blood's going to boil just like mine does. So insurance, I have such a chip on my shoulder about insurance. And I think we've talked about this before. And I'm actually, one of the social media posts that I wrote for next month has a comment about life insurance. One of the problems with insurance is that people, almost everyone thinks that they need life insurance. Whether they go and get it is another question. It's a separate question. If they do go and get it, they usually start off by going to a life insurance agent, someone who only sells life insurance. The problem with that is that a lot of careful. Yeah, I know. Almost anyone who sells life insurance has an inherent conflict of interest in that they make more money by selling more expensive products. And the only thing a lot of times that they can sell is life insurance, which we need life insurance people.
It's a saying, when all you have is a hammer, everything looks like a nail.
Everything looks like a nail.
Okay,
exactly.
Great.
Yes.
Could not be more applicable.
Yes, it could not be more applicable in this situation. I think that, and that's not to say that there aren't ethical life insurance agents, because I know several of them. But if you are not working with an ethical life insurance agent, you can end up with a highly expensive product that you don't need, especially because it is often the case. Imagine if someone is a life insurance agent and then one of your clients walks into their office and they have the opportunity to sell them business, and they going to do a thorough needs analysis like you and I would, because we maybe don't have to make the sale in order to make our month, or I don't have a month to make. It's rife with, there are a lot of challenges there. There are a lot of conflicts there. And I think that what a lot of people don't understand is that a lot of people don't need life insurance. That's one of the more surprising things that I tell people is, I'm looking at your situation. They're like, oh, probably the first step is life insurance. And I'm like, it's not a step for you.
No. And I think for a lot of people, it's probably a need or a want, right?
Yes.
And I talk to people all the time that you go through their analysis, you go through the financial plan, and I think it's because they've always had life insurance, or used to having it. It gives them peace of mind. But like, you look at it and you're like, you don't need it. There's nobody reliant on you financially.
Yeah.
If something did happen to you, your spouse or your adult children would inherit your investments and your home and all that stuff. So there would be money for like the basic expenses of a burial and all that stuff. You don't have to worry about that.
Right.
But they still, like, I want to know, I want to have the peace of mind that they would get the $1 million death benefit if I get hit by a bus tomorrow. And like, more power to you, as long as you
Yeah.
understand it's not a need. I'm not
Right.
recommending it, but if you want it, we can make that happen.
Right. Yeah, exactly. And there is an emotional aspect. There's always an emotional aspect to financial planning.
Mhm.
I tell this to my students at Fisher. But I tell this to all of my clients as well. I can put all the information into the financial planning software, and I can tell you what is the most financially optimal choice
Mhm.
for you to make. But there's also the choice that's right for you. And those two aren't always the same choice.
Right. I think I know we've talked about this before, but there's like the spreadsheet financial planning, which
Yes.
is what you're talking about, the optimal, let's put all the numbers in, this is what you should do.
Yeah.
And then there's we understand that you're not always going to make the optimal decisions because you're a
Yeah.
human being. So let's do 80% of it. And if you
Right.
do the 80%, you're probably doing more than most people.
Yeah.
I think if we can get that going, people will be in a better spot.
Yeah. And money is a tool at the end of the day. Money is a tool to make you comfortable and make you happy.
Yep.
As long as you're spending it the right way in other areas and you choose to, it's like someone who likes to buy cars every 5 years or they lease instead of own. It's making your financial priorities clear to you and then doing all of the rest of it right. To make sure that you can achieve those priorities.
Everyone has a voice. I think you can look at it. I know we made the comparison before, like your financial health to your physical health. If you look at what is the optimal diet, what should I be eating, and like you can lay it out, but realistically, most people aren't going to do that. But if we can eat pretty healthy, and then every once in a while have that ice cream sundae, you're probably in a good spot.
Sure.
Do what you can there.
They're calling me out on my ice cream sundaes.
I heard about that. Yeah. People are talking. Cool. We do need to wrap it up.
Okay.
So I'm going to give you one last softball. Anything else you want to talk about?
Just how awesome you are.
Wow.
Yeah.
Thanks. I appreciate that.
You should know that.
I'll toss that back your way.
Thank you.
John, thank you for being one of the good ones. Thank you
Yeah.
for joining the Roadmap to Retirement podcast. That's all we got for today, and we'll talk to you next time.
Awesome. Thanks so much.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.